I got the down payment, I got some cash in the bank to prove that I can cover this place for 12 months, 24 months, whatever it is. What is the due diligence process? What's the underwriting process? What are they looking for? What do I need to get ready before I even approach a person like you in terms of obtaining financing? Are they going to look at my Canadian credit score? Are they going to look at my tax returns, my notice of assessment? What do they want?
Great question. So it depends on the type of loan you're doing. Option one with the great rates, you're going to have to give them 2 years tax returns, personal and corporate if you're self-employed.
Okay.
Right? You're going to have to show where you live now to show that you have an owner-occupied property. And then they're going to want to see bank statements that, like, for example, if your tax return shows that you're making $250,000 a year, they want to see 20 grand coming through your account in that bank statement to support the income.
Okay, so they'll do some verification of the income.
For that loan that really gives you the great rates.
Okay.
Now, let's say that you're a Canadian who has the money to give down, but you don't have a tax return. This is a very, very common loan in the United States, and it's something called the DSCR. Me and Vito were talking about it earlier. And DSCR stands for Debt Service Coverage Ratio. And basically, DSCR, all that means is that the house itself is going to qualify for the mortgage based on the rental income it generates.
Okay, so that would be if we're getting a rental property.
So that's when you're getting, that's when you're doing the 2 and 3rd option. Not even the 3rd because they don't care about income. So the second option. So the second option is you can verify income standard with your tax returns. No problem. The property will qualify for you as long as you're giving that 25 to 30% down. The rate is higher by 1%. So instead of now looking at a 7.5, you're looking at 7.9 to 8.6, depending on how much down you give. Right?
And is that adjustable as well?
No, that one's fixed for 30 years.
It's fixed for 30
and they
years.
don't have a way to make it adjustable.
Interesting. So you're paying a premium for the 30-year rate.
Yeah,
regardless.
because they can't do a good due diligence.
Verifying income through tax returns.
Correct.
So
back to your premium product where you qualify through tax returns and it's your secondary property. Are they looking at if you have a mortgage on your primary property, and does that become part of your DTI?
Yes, 100%.
Okay, so you have to qualify
with your primary housing
expense.
They're not pulling credit in Canada.
Okay,
they're not.
So you
are
can
they
have
checking?
Credit cards maxed out,
That's what I was going to say. Are they checking your debt service ratio?
They will check your debt service ratio because they're going to see your bank statements and they're going to see what you're paying out. And like, for example, we had a client that had like 3 cars, all $2,000 of payments. Remember, he had a Ferrari, he had the Mercedes, and he had the Escalades.
Yeah.
But what we were able to do is, so he qualified, is we proved that the company was paying for it. We showed it on the tax return, and they took off all the debt. So there is credit qualification for that really good rate loan.
Okay.
You have to qualify for it.
Okay.
But again, it's more flexible than for Americans, and it's also if you can't come up with the tax return to substantiate it, then there's 2 more options.
But I mean, conceivably, like, the people that I'm generally dealing with producing their tax returns, producing their assessments from the Canada Revenue Agency, which is the IRS of Canada, proving the income is super straightforward.
Well, we've had one before where you've had to write an accountant's letter.
I wrote a letter explaining the person's situation, whatever, produce some financial statements, produce a tax return, produce a notice of assessment, and it was a relatively smooth process to buy a personal use condo.
It's not as complicated as people think.
Yeah, so I was quite surprised by the process. It definitely opens up an avenue for people that are high income earning, but not necessarily cash rich. Maybe they have a bunch of their own rental properties and properties in Canada that they're servicing. They have some cash for a down payment, but they can support the property through high income in Canada. So it's definitely sounds like a pretty attractive option. What are the sort of red flags or possible issues that a Canadian could run into when it comes to taking these types of loans? Like, what have you seen in the past that has become an issue?
That's a good question. So red flags, number one, I remember talking to a bank about this with a client. He had spent too much time in the U.S. and his visa was expired, and he was in the U.S. still illegally.
Okay.
So that kind of turned into an issue when the lender was asking for passport and documentation.
Yeah.
Because there's, again, it's only for a second home. It can't be your primary.
Right.
But they had spent too much time in the U.S. and they kind of messed that up. They fixed the situation with immigration, and then we were able to do the loan.
Got it.
Second red flag is if you have properties in the U.S. currently, because the lender will find it, and you're not paying that mortgage, or you're late, or you've messed up some of your financing in the U.S., because the banks in the U.S. have a system that it finds everything.
Right.
It's called LexisNexis. So people think that they can hide assets or assets that are not producing right now, or they're trying to do a foreclosure, bail out the properties in foreclosure, and they're not telling anybody, and they're trying to do that. That would always come up because there's a lot of technology now, and that always comes up.
Got it.
And then the third red flag, which is a red flag, but it's more pink than red, because there's ways of taking care of it. It's when somebody is not declaring any income at all, and they want to buy a house, but they have no way of showing where the money is coming from or anything else. And then we have plan B and plan C for those guys.
Like the drug dealer plan.
Yeah, I mean, we're in South Florida. Yeah. Everybody here deserves to get a home, and we have a loan for everybody.
Gotta live
somewhere. We're not judging anybody. Yeah. We're not asking.
I'm not here to judge, man.
We're not here to judge.
We're just facilitating the process.
Yeah. We're just helping you get some sun.
Got it. I got it.
We got to get you out of the cold and thaw.
I got it. Yeah, there's no cold here. This isn't Canada. Okay, so it seems like a relatively straightforward thing. You know, if you have the income, if you have the money, I really don't see a problem. Like, you know, the rates you're talking about are very reasonable. The terms seem to be very reasonable. I guess the big difference is, as we were discussing, in Canada, mortgages must renew every 5 years. Mm-hmm. This is not the case here. So someone who has a very long-term outlook could conceivably lock in a rate for a 30-year period.